Welcome back, everyone. Today, we're diving into the mixed bag of earnings from a dividend giant, Altria Group, ticker MO. Their latest report for the third quarter of 2025 tells a classic story of a company executing perfectly on one hand while fighting powerful market tides on the other. Let's break down what happened, why the stock sold off, and what it means for investors. Altria Group is a leading American corporation and one of the world's largest producers and marketers of tobacco, smokeless tobacco, and related products. Its most renowned and profitable holdings include the iconic Marlboro cigarette brand in the United States, alongside other well-established names like Black & Mild and Copenhagen. In response to evolving consumer preferences and a declining smoking rate, Altria has strategically diversified its portfolio by making significant investments in the smokeless and reduced-risk product categories. This includes major stakes in Juul Labs, a prominent e-vapor company, and Anheuser-Busch InBev, the world's largest brewer. Headquartered in Virginia, Altria's core business model remains focused on generating substantial revenue through the manufacture and marketing of its tobacco products to adult consumers, while navigating a complex regulatory environment and pursuing a long-term vision to transition beyond combustible cigarettes. First, let's look at the headline numbers, because here's where the contradiction begins. On the earnings front, it was a beat. Altria reported adjusted earnings per share of $1.45. That's up 3.6% from last year and just edged out analyst estimates of $1.44. So, a solid win on the bottom line. But on the revenue side, the picture was weaker. Net revenues fell 3% year over year to $6.07 billion. And when you look at revenues net of excise taxes, they were down 1.7% to $5.25 billion, which also missed what analysts were expecting. So, the immediate takeaway: profits were stronger than expected, but the underlying business is still shrinking. This is the core tension in Altria's story right now. So why did revenue decline? It comes down to the core business segments. The smokable product segment, which is their largest, saw revenue drop 2.8%. The oral tobacco segment fell even harder, down 4.6%. This isn't a surprise. It reflects the ongoing long-term decline in cigarette volumes as societal habits change.
But here's how they managed to grow earnings despite that: price increases and cost discipline. By charging more for their products and tightly managing their costs, they protected their profitability. In fact, their operating margin jumped impressively to 63.3%, up from 59% a year ago. That's a massive margin and a key reason for the EPS beat. Now for the part that income investors love. Altria is famously shareholder-friendly, and this quarter was no exception. They increased their quarterly dividend by 3.9% to $1.06 per share. That pushes the yield to a whopping 7.4%. They also expanded their share buyback program by $2 billion through the end of 2026. This is a clear signal for management that they are committed to returning cash to their shareholders, which is a huge part of the investment thesis for MO. Management, led by CEO Billy Gifford, emphasized their strong momentum and their progress in pivoting towards the future. They are focused on expanding their smoke-free product portfolios, looking at growth in international modern oral products, and even U.S. non-nicotine products. Reflecting their confidence in the profit story, they actually narrowed and raised their full-year 2025 earnings guidance. They now expect adjusted EPS between $5.37 and $5.45, implying solid growth. Okay, so with all this relatively good news, an earnings beat, a raised dividend, strong margins, and raised guidance, you'd expect the stock to be up, right? Well, no. The stock plunged roughly 7.7% following the earnings release. This is a classic case of the market looking forward, not backward. Investors are clearly concerned that the declining revenues are a long-term structural problem that even the best cost-cutting and price hikes can't fix forever. The headwinds from competition and the secular decline of the core business are just too strong to ignore.
Let's talk about why so many investors are still loyal to Altria. The argument is built on three powerful pillars. Pillar 1. Cash returns king. This is the headline. Altria's dividend yield is a massive draw, and the company has a proven history of paying it. But it doesn't stop there. They've just expanded their share repurchase program to $2 billion, running through 2026. This means they're committed to returning massive amounts of cash directly to shareholders, making each of your shares more valuable over time. Pillar 2. Financial discipline. Even as the core cigarette business shrinks, Altria has been a master at managing the decline. Through strict cost-cutting and strategic price increases, they've been able to sustain earnings growth. Their guidance for 2025 is for EPS growth of 3.5% to 5%, modest but positive. Pillar 3. The smoke-free future. Altria isn't just sitting still. They're betting big on products like their On nicotine pouches and the acquisition of Enjoy e-cigarettes. This is their plan for long-term survival, aiming to capture a new generation of consumers. Because of all this, many analysts see the stock as relatively undervalued, a classic value pick for those seeking stable, bond-like cash flows. Now, for the reality check. The challenges facing Altria are significant and aren't going away anytime soon. The biggest problem? The core business is in permanent decline. U.S. cigarette volumes are falling year after year. No amount of price hikes can fully offset this forever. It's a secular decline that erodes the very foundation of their revenue. Then there's the regulatory wall. The government is a constant threat. We're talking about potential bans on menthol cigarettes, higher excise taxes, and uncertain regulations for the very smoke-free products Altria is counting on. This creates a cloud of uncertainty that will never fully lift. And the competition is fierce. In the smoke-free space, Altria is up against giants like Philip Morris International, not to mention a flood of illicit, unregulated vapes. Their Enjoy acquisition, meant to be a leader, has been hampered by patent disputes and is struggling to gain real traction. Finally, inflation pressures mean consumers have less discretionary income, which can hurt demand for even addictive products like tobacco.
So, where does this leave us? The picture is a classic risk-reward balance. On one hand, you have a high, reliable income stream and a company aggressively buying back shares. It's a cash flow machine for now. On the other hand, you have long-term existential threats from declining demand, regulation, and competition. The bottom line, Altria is not a high-growth story. It's an income and value story. If you're a dividend-focused investor who understands the risks and believes management can successfully navigate the transition to smoke-free products, then Altria might be a contrarian play for your portfolio. As of late 2025, the consensus rating on Altria from about a dozen Wall Street firms is a resounding hold. Out of roughly 17 analysts, the breakdown is telling. Only about 4 are saying buy. The majority, about 5, are saying hold, and a cautious few, about 2 or 3, have sell ratings. But the most revealing stat is the average price target, which sits between $62 and $63. With the stock trading around $57, this implies the smart money sees very limited upside, maybe 10% at most from today's levels. Firms like Bank of America and Goldman Sachs have recently upgraded MO to a buy, with price targets as high as $70 to $72. What are they seeing? Their argument rests on 3 pillars. That incredible dividend, the yield is a massive magnet for income investors. Resilient earnings, despite the challenges, Altria's core business is still a cash cow. And share buybacks. The company is actively buying back its own shares, which supports the stock price per share. But then we have the bears, and their concerns are just as compelling. This is where firms like Morgan Stanley, Barclays, and Jefferies come in with their hold or even sell ratings and lower price targets around $50 to $57. So, where does this leave us? The bottom line is that Wall Street is deeply divided but leans cautious. Analysts appreciate the income-generating benefits. That fat dividend is very real. But they are equally concerned about the secular headwinds and regulatory risks that could cap the stock's growth for years to come. So what's your move? Are you Team Bull, Team Bear, or are you sitting on the sidelines? Let me know in the comments below if you own MO and why.